Hello, in this video, I'll teach you about the different types of moving averages and how to use them for trading stocks, forex and cryptocurrency. So stick around till the end of the video to understand. To define, a moving average is a stock indicator that is commonly used in technical analysis in finance. The purpose of calculating a stock's moving average is to smooth out price data by creating a constantly updated average price. So it is referred to as the moving average as it is continually recalculated, which is based on the latest price data. It is a trend following or lagging indicator because it's based on past prices. Now, to understand the best moving averages, we need to know about different types of moving averages. This includes the simple moving average, the exponential moving average, weighted moving average, double exponential moving average, and the triple exponential moving average. We will start with the simple moving average, which is the most basic moving average. It is calculated by adding the most recent data points in a set and then dividing the total by the number of time periods. An SMA is a lagging indicator because it is based on past price data for a given period and can be calculated for various price types such as high, low, open, and close. This indicator is used by traders to determine buy and sell signals for securities as well as to identify support. Like on the chart below, we can get a buy signal here when the simple moving average started to rise. We have a sell signal here when the simple moving average started to drop. Finally, we can join swing points created by the moving average to form support and resistance. When you join these swing points, you get a horizontal support and resistance level. To calculate the simple moving average, we can take an example. A stock trader wants to calculate the simple moving average for a stock by taking its closing price for the last 5 days. The closing prices for the last 5 days are as follows: $23, $23.40, $24.20, $26, and lastly $28.50. The simple moving average is then calculated as follows. So the simple moving average will be 23 plus $23.40 plus $24.20 plus $26 plus $28.50. Then you divide the total by 5. So the simple moving average will be $25.02. The second type of moving average we'll talk about is the exponential moving average, also called EMA. This type of moving average gives more weight to the most recent price points and make it more responsive to recent data points. When compared to the simple moving average, the exponential moving average is more responsive to recent price changes because it assigns the same weight to all price changes in the given time period. You can see on the chart the EMA is reacting more to recent prices than the SMA. When calculating exponential moving average, 3 steps are involved. First, we must compute the simple moving average for the given time period. The multiplier for weighing the exponential moving average must then be calculated. The final step is to calculate the current exponential moving average by taking the period from the initial exponential moving average to the most recent time period and multiplying it by the price. The final step is to calculate the current exponential moving average by taking the period from the initial exponential moving average to the most recent time period and multiplying it by the price multiplier and the previous period EMA value. The formula is as follows. Current exponential moving average is equals to the closing price of the exponential moving average previous time period times multiplier plus the exponential moving average of the previous time period. The third type of moving average you can check is the weighted moving average, which is used by traders to generate trade direction and decide whether to buy or sell. It gives more weight to recent data points and less weight to previous data points. It is calculated by multiplying each data point by a weighing factor. Traders generate trade signals using the weighted average. When prices are above the weighted moving average, for example, it indicates that the trend is upward. However, if the prices are lower than the weighted moving average, it indicates that the trend is downward. On the price charts, the weighted moving average of the last 9 periods of the pound card is plotted as a line as shown below. The fourth moving average we'll talk about is a double exponential moving average, also called DEMA. Double exponential moving average is a better version of exponential moving average because it gives more weight to the most recent data points. It has less lag and is more responsive, which helps short-term traders in quickly detecting trend reversals. Let's take a look at the pound card prices over the last 9 days. The red line represents a simple moving average line. The purple line represents an exponential moving average line, and the yellow line represents a double exponential moving average line. According to the above chart, the double exponential moving average is the closest to the price points and has the least deviations. Because the double exponential moving average line most closely resembles stock prices, it is the most sensitive to stock volatility. Volatility changes are good indicators of trend reversal. The last type of moving average is the triple exponential moving average. Triple exponential moving average reduces exponential moving average lag and makes them more responsive to price changes. Patrick Malloy created the triple exponential moving average, also called TEMA, after developing the double exponential moving average in 1994. The triple exponential moving average, like the double exponential moving average, reduces the lag difference between different exponential moving averages. Double exponential moving average and triple exponential moving average differ in that triple exponential moving averages formula includes a triple smooth exponential moving average in addition to the single and double smooth exponential moving averages, which is used in double exponential moving averages formula. Triple exponential moving average is shown as the red line in the chart below, and double exponential moving average is shown as the purple line. So this indicator created using these three exponential moving averages produces a moving average that stays even closer to the price bars than the double exponential moving average. To summarize, for short-term trading, you need short period settings like 21, 9 and 13, and also a moving average which will react to recent prices faster, and that can be the EMA, the triple exponential moving average, and the double exponential moving average. In contrast, for a long-term trading, you will have to set longer time periods like 50, 100, and 200. The longer the time period for the moving average, the greater the lag. So a 200-day moving average will have a much greater degree of lag than a 50-day moving average because it contains prices for the past 200 days. The 50-day and 200-day moving average are widely considered by investors and traders because they have greater trading signals. Moving averages of 20, 15, 50, 30, 100 and 200 days are the most commonly used time periods. The shorter the time period used to create the average, the more sensitive it will be to price changes. The longer the time period, the less sensitive the average will be to price changes. Shorter moving averages are typically used for short-term trading, while longer-term moving averages are more suited for long-term investors. When it comes to moving averages, there's no right or wrong time frame or settings to use. The best way to determine which one works best for you is to experiment with various time periods until you find one that fits your strategy. The 50-day and 200-day moving averages, when used together, provide powerful trading signals in the market. Typically, the crossing of a stock's 50-day moving average above its 200-day moving average is a strong indicator that the stock has begun an uptrend. In contrast, a stock's 50-day moving average crossing below its 200-day moving average can indicate a downtrend, and it's commonly referred to as the dead cross. So to trade with a moving average, you need to understand several concepts. A rising moving average indicates that the security is in an uptrend, so you can take long positions, putting your stop loss below the recent higher-low area. While a declining moving average indicates that it is in a downtrend, so you can take short positions, putting your stop loss just above the recent lower high area. When the moving average is horizontal, it indicates that the market is ranging, so it's advisable to avoid trading in such market unless your trading strategy is for ranging markets. To understand moving average crossover, upward momentum is confirmed by a bullish crossover, which occurs when a shorter-term moving average crosses above a longer-term moving average. In contrast, downward momentum is confirmed by a bearish crossover, which occurs when a shorter moving average crosses below a longer-term moving average. As a lagging indicator, the moving average is primarily used to identify the trend of any financial security rather than providing trading signals. Moving averages, like other technical indicators, should be used in conjunction with other technical tools such as price action or momentum indicators. A simple moving average is simple to calculate. It can be used quickly and easily. The greatest strength of a moving average is its ability to assist a trader in identifying a current trend or spotting a possible trend reversal. Moving averages can also be used to identify a level of support and resistance for a security, as well as simple entry and exit signal. Watch my next video on best moving average strategy that top traders use to get more profitable in a trading journey. If this video has been helpful, remember to like, share and subscribe to the channel for more future content like this. Till next time, see you.